Retirement is supposed to be a time of peace, freedom, and well-deserved rest. But for many, instead of enjoying those golden years, you find yourself trapped by something heavy, relentless, and all-consuming: debt. It's a reality that's hitting millions of Americans today. Rising mortgage rates, healthcare bills, credit card balances, and these burdens don't disappear in retirement. In fact, they grow, and oftentimes faster than people expect. In today's episode, we're diving deep into this hidden crisis, exploring how debt is impacting not just the finances, but the mental and emotional well-being of retirees everywhere. Because let's face it, debt doesn't just affect the bank, relationships, and your peace of mind. So if you're close to retirement, already retired, or simply looking to support a loved one in this journey, this topic couldn't be more important. Together, let's uncover some actionable ways to lighten the load, regain control, and bring back the peace that we all deserve in our retirement years. Stay tuned, because this information could be the key to a brighter, debt-free retirement. Welcome to Retirement Rescue Weekly, where we throw a lifeline to your financial future. This podcast is dedicated to helping rescue retirees from potential dangers that appear in retirement. I'm Kurt Arnold, your host and financial advocate. I'll guide you through the stormy seas of retirement. We'll tackle inflation, taxation, market volatility, and healthcare costs. Together, we'll secure your retirement. Tune in and start your rescue mission today. Well, hello again. Welcome to Retirement Rescue Weekly. I am Kurt Arnold, financial advocate and host. Thank you for joining me for another episode. And today is going to be a tough one to talk about. Seems especially in recent years, debt has been a big problem for a lot of people, and especially for retirees. You think about it, you are on a fixed income, but your expenses are rising because interest rates have gone up and other things out of your control are going up. And so this is one that gets really sensitive. I've had people sit across me and start crying because of the weight of financial stress on them from debt. And sometimes it's not anything that they did themselves. It wasn't like they made poor choices. It's maybe a healthcare event or something that happened, and now they're in a bad situation. So we're going to kind of dissect what this debt can do in retirement and kind of show some ways that maybe we can take some action to try to resolve this. So let's get into today's show. Today's show, The Retirement Trap: Why Debt Can Sink Your Golden Years. As I always do, I like to start with a quote. Benjamin Franklin says, "Creditors have better memories than debtors." I think we can all agree with that. Sometimes it's fun to spend, but it's not fun to repay. If you think about it, sometimes too, just as a reflection point, sometimes even like just that going through the drive-through at the fast food place, if you put it on your credit card, you're actually adding another 20% to what you're paying, just because of, we're using the wrong form of payment. So we're going to talk about debt today, and debt, we're going to kind of show what it looks like today, and what it's kind of causing for some of the retirees out there today. So let's get into that.
I call it the work, retire, repeat syndrome. More than half of the people who are retired right now do not have enough money to be retired.
Retirement is supposed to be the golden era of life, a time of relaxation and enjoyment. But for many, it's anything but golden. Instead, it's overshadowed by the heavy weight of debt. Today, the average retiree carries more than $20,000 in non-mortgage debt alone, which includes credit cards, car loans, and medical bills.
We do find a lot of older Americans in retirement end up with debt, and that may be very burdensome since they're living on retirement income.
More than 40% of retirees have outstanding credit card balances, and the interest rates are often crushing. Credit card APRs frequently exceed 20%, making it nearly impossible to pay down the balance. The burden only grows month after month. In mortgages, it doesn't stop there. An estimated 44% of homeowners aged 65 to 74 are still paying off mortgages with an average remaining balance of over $130,000. These debts devour a large chunk of fixed retirement incomes, forcing many to make difficult choices between essentials like food and health care and debt payments. Meet David. He worked hard his entire life, believing his home would be his nest egg. But now he owes over $300,000 on a house he's struggling to afford. Every month he spends most of his Social Security income just to keep a roof over his head. The consequences are staggering. Over half of retirees surveyed said their financial stress has negatively impacted their health, causing sleep loss, anxiety, and even physical illnesses like heart disease. Studies show that debt-related stress increases the risk of depression and can shorten life expectancy. Meet Margaret. After paying her medical debt from an unexpected surgery, she can't afford her medication every month. Nearly 20% of retirees report skipping doses or delaying medical care because debt consumes their income. The fear is real. One serious health crisis can mean financial ruin.
Debt is not just about a financial number. It's about how it weighs on people to keep them back.
And it's not just about the numbers. Debt robs retirees of joy and connection. Imagine missing your grandchild's graduation because travel costs are unaffordable, or being unable to join friends for simple outings because your budget is stretched too thin. But there's hope. While the situation is dire for many, there are ways to reduce this burden. Debt shouldn't define your retirement. It's time to take control, find relief, and rediscover the life you worked so hard for, because everyone deserves to live their retirement with peace, not pressure. All right, so it's obviously some troubling numbers to think about. Let's dive a little deeper. Rising debt for retirees in 2023. Over 40% of retirees are carrying some form of debt. And the average debt keeps rising, which is continuing to create these financial strains. What this happens then too, from a financial planning standpoint, is it's now starting to cause risk of outliving your money, and also affecting your ability to have some financial flexibility. So maybe you're starting to kind of corner where you have less options now. It has an impact on the well-being, as we talked about. It's going to cause more stress, which can lead to mental and physical health issues. It's going to cause anxiety, depression, poor physical health outcomes. In 2022, retirees in debt, 40% more likely to suffer stress-related health issues. So this is a huge impact on the overall well-being. So let's talk about credit cards as part of that debt. In credit card, the average credit card debt for retirees is estimated to be about $7,000 with minimum payments of $300 a month. Most struggle to pay the minimum payment, so which means we're never going to get out of this because we're not paying anything more. So that's going to continue to be there. And as you saw recently, when the interest rates got really high, the credit cards, because it's a revolving rate, they raised their interest rates, and then that affected the minimum payment then too. So if you're on a fixed income, if you have Social Security and maybe drawn from assets, this is something that you can't really afford to have keep going up and never going down. So that's where it can really cause some issues. Mortgages. Now mortgages, back in the day, it used to be like you had to have that mortgage paid off before you retired. Not necessarily so much today, because obviously some people might have taken advantage of lower interest rates during the pandemic when they got down to 2.5, 2 3/4. Recently, obviously now they're up in the 6-7 range, so that's different. But if you happen to be fortunate to have that low interest rate, it doesn't necessarily mean you have to have that paid off. It could be okay, but if it gets higher, then yeah, obviously that's going to have an impact. Mortgage debt, though, 44% age 65 to 74 have mortgage debt. 27% of people over the age of 75 have mortgage debt. So if you think about your monthly expenses, this is going to be a big expense that's going to be out there for a lot of people in their retirement years. 30% of homeowners over the age of 65 are considered house poor. House poor meaning that greater than 36% of their income is going to housing expenses. And housing expenses is not just the mortgage or rent. You got to think about the insurance and all the other parts, taxes, things like that are going to be included in that. So house poor, we don't want to be house poor, because now we are really up at a corner there too. We used to always joke, you can't eat your house. So if you need more money, you can't just all of a sudden, take a slice off the house and then turn that into the money. So you don't want to be house poor, because that really puts you in a corner. Medical debt. This is the big one that's really happening lately. And it's one of those things too. It's not even like, again, it's not even like something you did. It's not like a bad choice you made. It's just life. 25% of retirees their debt is due to medical expenses. And some of this is just out-of-pocket costs for hospital stays or long-term case. I have a family member that their medication is not covered by Medicare, their drug plan. And so they have to go to the provider every year and try to get grant money to pay for the drug. If they don't have that, which it dries up quickly, it's like $18,000, $20,000 a year for that drug that they need. But Medicare won't cover it because it's not considered something that will heal them. So it's an expensive drug that helps with quality of life, but it's not covered. And this is where it really hits them. Long-term care needs, we talked about that in previous episodes. That's going to continue to be a big burden for a lot of people as we live longer. And we have a lack of facilities and workers, especially too. The average retiree is expected to need about $300,000 to cover medical expenses in retirement. A lot of people didn't plan for that. So that's where that's going to cause a lot of extra costs. So caution, one thing I want to tell people is before they retire, if possible, try to be debt-free, with the exception of mortgage, depending on what the interest rate is. That's where it's up for debate, but try to be debt-free before you retire. Now, I had a couple I worked with a couple of years ago. They had $100,000 in debt that was non-mortgage related debt. The wife was freaking out because she's like, I don't want him to retire with that debt there. So I want to figure out how do we get that debt taken care of before I'm going to let him retire. That's what she said. So if you get into retirement, then it's a lot harder. If you can, really double down and work hard and try to pay off that debt before retire, it's a lot easier. Also understand that when you get into retirement, your income has changed. Now that paycheck of income is not there anymore, and now you're building that paycheck. It's a little bit tougher sometimes to get approved for lending with, banks and things like that, because what they're looking at is what income do you have on a monthly basis versus expenses, looking at debt to income, debt to credit, things like that. And you might not have enough income to qualify. Maybe you're pulling money when you need to from your retirement assets, but it's not a regular income stream. So then they're going to say, well, you don't have enough income. And that's where you have to get creative. So understand that complexity too. I used to do lending back in the day, so that's why I know a little bit about that. But understand that things change when you get into retirement as far as income, as far as what lenders are looking at. Now let's look at some debt strategy. We're going to give you a piece at the end here you can download to help you with assessing your debt situation. So make sure to stick around for that. But it's always important you start and look and see, what are we looking at right now? What's the debt situation like now? And you start kind of listing them and understanding what the rates are, the minimum payments, things like that. Prioritize debt strategically. Now, Dave Ramsey made it very famous in recent years about the debt snowball, where you pay the smallest balance aggressively. And then once you pay that balance, you take that amount that you're paying on that, and you snowball it to the next one, and so forth. When we got to a high interest rate environment, actually, I started talking a lot about the debt avalanche, because as people had credit cards, for instance, that were getting, 20, 25% interest rates, that was hard to deal with. So we started getting more aggressive with some of these, looking at a little bit different approach for how we actually address that debt, because of what it could actually do for minimum payments, which put a really big crunch on people then. If you have a budget, we need to maybe look at adjusting it. And if you don't have one, you should probably have one. I know we don't like the B word, but there's different ways to, have some, I always kind of say, some guidelines, or if you think about, just some parameters to have some money within certain parameters. Make sure you have an emergency fund, because one thing we do know is that the unknown will happen. We don't know when or where or how much, but it will happen. And when it does, we can much easily weather that storm if we have an emergency fund, rather than using a credit card or having more debt added to our budget then. For some people, it might make sense to downsize. I'm not saying you should do it, but it might make sense because maybe the house is already a lot free, as it is anyways, but maybe there's some financial help by downsizing, where maybe that will lower your monthly costs, and maybe you get some financial liquidity from that you can use to help live off of as well. Right now, we're not in a refinance market yet, but keep an eye as the interest rates start going down for mortgages. Typically, if you can get a mortgage that's about 1% less than what your current mortgage is, it does make sense typically with the math that it will pay itself off pretty quickly. And then think about too, what it does for that payment. Now, I had a person I worked with a couple months ago. We actually did a refinance that actually added years because we were trying to bridge a gap for him to get to age 60 because he couldn't get access to his pension and stuff like that until 60 and couldn't touch his tax deferred assets till 59 and a half, essentially. So because he retired early, he was a federal worker, we had to figure out how we could lower his income or lower his expenses and create enough income to cover that gap. So because he wasn't going to stay in that house forever, we thought, well, let's kind of, think about it like it's a rental, almost like you're the owner and you're the renter. Let's lower that monthly payment. And then let's get through these next 2 years so we can actually get to the other side of this and be okay. Make sure you're reviewing healthcare and insurance plans annually. This is open enrollment season. If you're in Medicare, and if you're on the marketplace, things like that, please do that. These plans change every year. If you're in the wrong plan, it can be very costly. If you end up having, the wrong prescription drug plan, for example, your drugs could possibly not be covered. And if they're not covered, then you're paying out of pocket. And then also, sometimes you might want to think about generating additional income. That's where it might make sense to go work part-time for a period of time and maybe just work hard to pay that debt off. And it doesn't have to be a long time, and it doesn't have to be, full-time, but maybe you do that, make a couple $100 a month, and then you can start paying off the credit card faster. Again, we go back to the importance of financial planning, because then we're looking at understanding what our true expenses are, our income sources, and making sure we can account for that. We got to have a plan for the budget, though, too. And when we talk about financial planning, it's kind of like the target. We have to understand how much we need per month to cover, and then we work backwards from there. So if you said, I need about $5,000 a month to work off of, then we work backwards from there to see how do we get there. And we have to account for inflation and things like that as well. So to really get an accurate look at monthly expenses, we have to think about a couple of things. And by the way, from the financial planner side of me, I'm amazed by how many people don't know how much they spend per month. Shouldn't be amazed, but it's the way it is. And I've had some people that were way off. Like I had one couple, they thought, oh, we only need about $6,000 a month of income. And truly the way they were set up with a mortgage, stuff like that, was closer to 11,000. It was way, way off. And so we had to kind of help them through an exercise to help them understand what they're spending. They were surprised, and they're like, wow, we gotta do something about this because we're spending way too much money. But what you want to do is you kind of want to track your spending for about 3 to 6 months and see like what's typical, because you're going to have some months where you're spending more and some that are less. You want to categorize your spending too. Like, where are we spending money at? What types of things are going for spending? Account for regular expenses. Like think about insurance, where maybe you only pay that every 6 months or quarterly, because that needs to be figured into that as well. And then unexpected expenses. There will be unexpected expenses, so make sure we account for that as well. Like having to get the car fixed because you're got a hole in the tire or whatever. You got to account for those things. One thing that's really easy to help people is say, go back to your credit card and bank statements and just start going backwards, and then go and document what those expenses are. Is that a regular expense or a non-regular expense? And then what kind of category is that? Is that a need or a want? And then start understanding how you're spending, because sometimes, life gets busy. We start moving fast and we don't realize what we're spending money at. Separate needs and wants. We got to make sure we're covering the essentials. And then there's some things that, we have this dream, this picture of what we want retirement to look like. But to do that, we got to make sure we can cover it. Travel, spending time with the family, things like that. We got to make sure we understand we cover those needs first. And then what can we cover with the wants and how we plan ahead? One thing that people don't account for, though, is inflation. Inflation, typically if we're doing an inflation plan, we're typically looking at like 2.8% or so on inflation historically. So, if you need $5,000 a month today, just know that over the next 5-7 years, that's going to go up quite a bit. And then if you're covering a retirement that's 25 years, it's going to be a lot more they're going to have to cover. So then what are your income sources going to be growing at versus your expenses? Think about your future costs too. Maybe you want to replace a vehicle every 5-7 years, or maybe you want to, fix a room in your house, whatever. What are those future things that are coming up that you're going to want to account for as well? Now, some guidelines that I like to use. Think about, when you're driving down the road, those guardrails. The guardrails aren't right against the road because they give you some wiggle room, but they're meant to keep you from going over the cliff. So if we can stay within parameters, we can kind of adjust it accordingly to us, but make sure we're still within reason. So housing expenses, we want to be somewhere in that 25 to 35% range. And housing expenses, everything housing, rent, mortgage, property taxes, HOAs, all that stuff, all that and property insurance, all that stuff that we want to have in there. Medical, healthcare expenses, 10 to 15, transportation expenses. If you want to replace a car every couple of years, lease, buy, whatever it is in that range, food, groceries, things like that, travel, leisure, debt repayment. Now, here's the thing. If we don't have debt because we paid that off before we retire, we can dump that into travel, leisure more. If we are paying off our mortgage and we get rid of this mortgage, yeah, we're still going to have some housing expenses, but maybe we don't have as much. We can dump it into food and leisure or travel or things like that. So that's where this can kind of come in, but we got to have these guardrails first, or else things can get really out of whack. So again, today, a tough topic to talk about, debt. I think we all know we don't want debt, but we have debt, and sometimes life happens. What we want to do is to kind of educate you on where things are going and help you understand how important it is that we get our hands around this and get it taken care of before it gets really out of control. As we like to do always, we like to teach, but then we also want to make sure you have an actionable thing you can take and work on yourself. So we created this free resource called Mastering Your Budget, which is basically a downloadable resource that can help you start kind of mapping out your expenses and categorizing those expenses to help you get an idea of what you're actually spending. So that you can kind of figure out where should we be expense-wise and are we covering things okay? We're going to have a link in the show notes for that so you can actually get to that resource. Pretty easy to get to. Make sure to take a look at that. And even if you think you got a good idea for expenses, you'd be surprised sometimes. Go back and just kind of take a look at it and see if things have changed over time. Because obviously inflation and different things can have an impact. But once again, we want to thank you for joining us as you do. We appreciate you coming here and learning and giving me the opportunity to teach. I love being able to teach. We are live every Thursday, 11 a.m. on the East Coast and 8 a.m. on the West Coast. Thanks again for joining us. And until next week, have a great week.